How does the borrowing capacity differ? So from someone who might be living in their home, have a call it a $600,000 mortgage,
Yep.
or someone who's actually renting, even if the rent is the same amount as say what the home mortgage would be, how does that differ from their borrowing capacity when they actually go to buy an investment property?
Yeah, so the bank's calculations are that they will look at existing debts. If it's an owner-occupied debt, there's no benefit from a servicing calculator point of view. If it's an investment debt, then the banks will factor in their servicing calculators your gearing benefits. So knowing that you're going to get tax break on the interest is clearly then going to bump up your capacity a lot.
Yep.
There's a rental income to be considered. There's also a rental expense as well for where you're
What
living.
about taking into consideration the expense of rent
Yep.
versus the expense of a home mortgage payment?
So a home mortgage repayment will most likely be expensed higher because they factor in an assessment buffer. If your rate is at 3%, the bank factor in 9% against that commitment. So it's loaded for any potential future rate changes. And the bank being conservative under their responsible lending, they'll add a little bit of a buffer.
And then wherever there's rent, it's just literally that rent amount that
The actual expense,
Yeah.
correct. Yeah, exactly.
Which then obviously allows them to have a higher lending capacity to get to those investment properties.
Correct.